Welcome to Mad Money. Welcome to Cramer. I've been my friends. Geez, I'm just trying to save a little bit of money here. My job is not just to entertain, but to educate, put in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Tariffs do matter. They raise prices almost immediately. If you slap a 25% tariff on all of the cars and trucks we import from Korea and Japan, you're talking about roughly 17% of the vehicles sold in the U.S. last year. Today, President Trump did precisely that, which would be a 25% price increase on about 1/6 of the U.S. auto market. And that's on top of the existing tariffs on everything from Japan and South Korea. Now, that's big enough to cause some inflation, which is a major reason why the averages rolled over today. Dow tumbling 422 points, S&P falling 0.79%, and the Nasdaq losing 0.92%. That's a significant pullback. But you know what? A few months ago, I would have expected a much bigger decline in the stock market on this news. Keep in mind, we have a big persistent trade deficit with both Japan and South Korea. You tackle on a big tariff on imports from those countries, and suddenly about 17% of vehicles made there and sold here are priced out of the market. In other words, this is great news for domestic automakers. Ford and GM should be able to clean up. Yet both their stocks went down today. Sounds like not everybody believes. That wasn't all. That wasn't all Trump did at all. He put a 25% tariff on imports from Kazakhstan, 30% tariff on South Africa, 40% tariffs on Laos and Myanmar, the country formerly known as Burma, which would have been easier to pronounce. If this had happened in March or April, the averages would have been down a heck of a lot more than 1%. I'd say 3, maybe 4. So is the market just ignoring these numbers? Not necessarily. It's possible that when we digest these new tariffs on top of others that are coming, more sellers might appear. Even after today's pullback, the market remains very overbought. We are vulnerable. If more countries refuse to play ball with President Trump on trade, they're going to get some very similar letters from the White House, and Wall Street doesn't want to see that. But you know what? The last time the stock market got this overbought, we had a similar sell-off like this. Happened the next day. Then a week later, we were up 3%. So if you sold at these overbought levels, you missed out on a big move. At this point, we've been conditioned to buy, not sell on weakness, which is just by rote, and including tariff-induced weakness. That's part of the psychology. A bigger part, though, these tariff letters are starting to feel a little like a visit from Borat. You aren't sure whether they hold up under close scrutiny, especially the one to Kazakhstan. It's like they're picking a tariff hat, picking numbers out of a tariff hat. What can I say? I have mine. Kazakhstan, let's see. Whoa, geez, we crushed them 80%. Whoa. Malaysia, what are they getting? What are they going for? Oh, 32.44%, a little more specific for Malaysia. Myanmar. Oh, I've always wondered what they're going to be for Myanmar. Oh, my, 45%. That's a lot. Oh, my God, well, I've got it. I've got Oceania. Oceania's getting 40, all right. How about Eurasia? That's a good one, 49.9. And then finally, Fredonia, maybe the most important country of all, 39.42%. Fredonia, not bad. They got away with a lot. Now, nobody knows whether to take them seriously. I obviously don't if I talked about 2 countries from 1984 and a third from the Marx Brothers. We have all sorts of due dates. We have all sorts of percentages. We have little consistency. Japan and Korea make a lot of cars here. But like with Apple, which has pledged to invest $500 billion across America, building things here does not get you in the president's good graces. There is no immunity in this tariff survivor game. Because these numbers seem all over the place and the White House has repeatedly postponed or reduced its tariffs, it's really hard to tell what's happening, isn't it? How many tariffs will be renegotiated? How much will go through? Potentially causing inflation and making it harder for the Federal Reserve to cut interest rates. How much does any of this even matter, big picture? Compared to our trade deficit with China, our trade deficits with these other countries are practically chump change. My view is worth 25%. Plus, again, every one of these new tariff proposals could be lowered as part of negotiation. It's all scattered. Who knows what will happen next? We're gone. We're done. I think that there are a lot of misunderstandings about these announcements. You have to go back to what Trump said, though, when he was running for president. This is really important because people forget. And I went over this with Peter Navarro, trade rep, today. People are missing what he first said. Back then, President Trump said that our trading partners took advantage of us by buying nothing from us and then demanding that we put up plants in their countries so they want to do business there. And that was very bad and very understandable for most of America. Now he's saying these countries don't buy enough from our country anyway. Maybe when they see these tariffs, they'll buy something as a gesture of good faith. That means you want to buy the stocks of American companies that make big-ticket items that you can't get elsewhere. I'm talking about Boeing planes, huge turbines from GE Vernova, machinery from John Deere, Caterpillar, Cummins. That's what countries will have to do. They'll have to buy that stuff to get into President Trump's good graces. And that's what this is really about. How can I talk about buying anything in this environment? Because I think Trump's ultimate goal with these tariffs isn't to force companies to build new plants here anymore. It's simply to sell more stuff overseas. Be good trading partners. That's good for profits. It's good for stocks. It's bullish. How about all the cars that Japan and Korea make here? The White House seems to believe that those foreign automakers basically do most of their manufacturing overseas. Then they assemble the cars here. The intellectual property, the big engines, that stuff, it's all made over there, put in the bodies here. So again, there's no immunity for doing business here when it comes to trade, because the president thinks that almost everyone is a bad actor when it comes to exploiting our country. And you know what? I think most of Americans agree. Now, aside from trade policy, I believe what really matters here are the provisions in the big bad budget bill. Even though it will add trillions to the national debt, not happy about that. This legislation is full of stuff that will ignite the economy, all sorts of accelerated expense write-offs that will cause a fire hose of construction. With all of that on the way, it's hard to really get worried about these trade negotiations. And that's why the stock market can't collapse. That and strong employment. More on that later. So let me tell you what we're doing for the Charitable Trust. We no longer believe that the tariff numbers for the president throwing around are meaningful. They're just a starting point for negotiations with countries that really need access to our markets. Will tariffs be inflationary? Right now, the market's trading like it doesn't matter. It's not going to influence J-Powell as much as you might expect, because it seems very one-off. Of course, if these numbers are the real numbers, then yeah, it's going to be a bit of a problem. But nobody believes they're the final numbers. So we're making some small sales with the trust in order to take advantage of the profits that others want to take. Look, I don't want to be glib. I know we're staring down the barrel of a tariff gun. But if I'm right that the president's game plan is really to help our manufacturers export more merchandise, it's hard to make the case that we need to do really huge amount of selling here, unless you're ringing the register on something that's had a huge run or something that's a dog and didn't move at all. But the bottom line, when the only stock that's down enough to create a real price break is Tesla, largely because Elon Musk trying to get back into politics instead of humanoids, it's tough to pull the trigger. Maybe if we're patient, we'll get a better buying opportunity. That was a bad number. 32.4 was a bad number. So why don't we start with Chris in North Carolina. Chris.
Hey, Jim, how you doing?
I'm doing well, Chris. How you doing?
Very well. Hey, I know NVIDIA dominates all the talking points, but I'm heavy on Micron. Last 3 years, it's been up 50%. I'm also in NVIDIA. Last 2 years, it's been up 100%. But I'm wondering, with Micron making both NAND and DRAM memory chips, aren't they in a better position to dominate AI over the next 5 or 10 years?
I can't tell you how glad I am that you brought up Micron. Micron stock ran up huge into the print, so to speak. And then when the print came out, it was excellent. Since then, the stock has been going down. We've seen this pattern before. By the way, we saw the same pattern in TJX. It's rather remarkable. It took far longer to settle down than I thought. Micron, you buy some tomorrow, and then you buy some, and you wait a 10% interval. I'm not kidding, 10%, because I don't know where the bottom of this thing is, but you can start tomorrow because it's down that much from the high. All right, in today's sea of red, I don't see a lot of areas where it would be prudent to sell, but we still have to be patient for some buying opportunities. We need some cash. The market is very overbought, and wow, that's a very specific number, 32.44. I wonder who that belongs to. On Mad Money tonight, CoreWeave announced its acquisition of Core Scientific in a $9 billion all-stock deal, and I'm hearing more about the vision of the combined companies with CoreWeave co-founder and CEO Mike Intrater. Then the Labor Department's non-farm payrolls can tell you a lot about the state of this market. I'm going off the charts with legendary Larry Williams to read the labor market tea leaves, and you did stump me with this Leonardo DRS. I did the homework over the long weekend, and I'm ready to share my thesis. So 45% are going to stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
This morning, we got some big news from CoreWeave, the data center operator that we've championed. It makes its money by renting out computing power, especially for artificial intelligence. The stock came public with a whimper in March before going on to become one of the best performers of the year. Today it got hit after CoreWeave announced that it's buying Core Scientific, another data center infrastructure play, for $9 billion all-stock deal. These two companies are already long-standing partners. CoreWeave has been paying to lease Core Scientific's infrastructure for years. So now they own it outright. Very positive. And hey, given that this stock's up almost 300% from where it came public, they should be using it to pay for acquisition. That's smart. Of course, the market didn't love the transaction. CoreWeave fell more than 3% today. Core Scientific plunged almost 18%, in part because we've been hearing rumors of this deal for a week and a half. So Core Scientific shares had already run, and the ultimate deal price tag was a little lower than expected. When it comes to this company, I'm a believer, and you know that. But why not go straight to the source with Michael Intrater? He's the co-founder, chairman, CEO of CoreWeave, to get a better sense of what's happening. Mr. Intrater, welcome back to Mad Money.
Thank you for having me. Great to be here.
All right, so Michael, once again, we have to explain to people that this was actually quite a good deal for you, in part because of your long-standing relationship. Maybe you can tell us about the Core Scientific deal. I know you wanted them even last year for a much lower price. It was worth it even at these prices.
Yeah, so one of the things important to understand is that the two companies have been working together for an extremely long time. Our first contract with Core Scientific dates back to 2018, where we used them for hosting resources on GPU compute for cryptocurrency mining. And so we really know the team over there. They really know us. There's a lot of synergy between them, the two entities. Right. And there's a lot of positive goodness to be extracted from just the interaction of these two entities. Over the years, we've kind of built and expanded our relationship as our company has evolved. They have evolved with us. They have built up infrastructure that is capable of supporting the type of compute that drives our business forward, the accelerated compute, the HPC. And we continue to work with them really closely, and it became an opportunity to kind of bring them under the same tent to work with us and to build a larger company that's capable of building and extending the offerings that CoreWeave brings to the most demanding AI clients in the world. And we took advantage of that. We moved forward in a really great deal with them that I think will be very accretive to both parties. And
you mentioned special things that they have. 1.3 gigawatts of existing gross power capacity. It's really pretty terrific. You can use that immediately.
Yeah, so we've got a pretty big footprint with them already. I think we're about 850 megawatts worth of infrastructure already contracted with them. They've got additional capacity within their fleet that is some of it is going to be able to be repurposed to extend our continual build of infrastructure. Some of it probably will be more crypto focused over time. And
so you're going to keep some of the crypto?
We intend to disgorge the company of the crypto-only assets that we don't really feel like can be efficiently or economically converted into HPC.
But management of Core Scientific, when I spoke with them, felt that almost everything could be repurposed for you.
Yeah, so with enough time and money, I think everything could be. Okay. For us, it's just a question of which assets are located in jurisdictions and have access to infrastructure that make it most productive for us.
Now, it was worth it, obviously. The deal last year would have been something if you could have been able to get it for $5.75 in cash, though. The way this deal's worked, the way I look at it, this actually builds your equity up. People have to understand the way you do your accounting and how this makes you even better in terms of less leverage.
Yeah, so it actually does take down our leverage ratio.
Yeah.
One of the things that,
because the bears were saying leverage. You and I were saying $40, giving it away.
Yeah. So you're absolutely right. Like it does incrementally bring down our leverage, which is great. And it really does allow for an opportunity for us to expand our footprint and to ensure that we're in a position to provide best in class infrastructure to our clients.
Right. Now, one thing people have to recognize is that you kind of, I don't say you leaked it, but you kind of made it pretty clear business is dynamite right now.
Yeah, listen, we're busy. We've got a tremendous amount of demand for the product that we bring to market. There's a little bit of a misunderstanding still within the market in terms of how important the software stack that we have built and augmented.
People just think you're just like you're just a REIT.
Yeah, that's look. You and I talked about this right at the beginning. The market's going to take some time to understand the extent of our business and the differentiation that's associated with how we go about running the software that drives the infrastructure. Earlier this year, we acquired Weights and Biases, and that's a really great example of reaching up the stack into the software layers, as opposed to Core Scientific, which is really more down the stack into the physical infrastructure. And by putting that all under the same roof, we feel like we're really able to drive tremendous shareholder value.
Now, let's for something that people maybe understand in terms of strength. Not everybody got the NVIDIA GB300 NVL72 platform so fast, did they?
Yeah, so it's not even a question of whether or not they got the platform this fast. It's a question of, is their infrastructure, is their software stack built to be able to bring that online? And, other people got it actually before we did, but our ability to kind of take the infrastructure and operationalize it and deliver it into a performant configuration for commercial use is just unmatched in the market.
Right. So you're still speaking to Jensen Huang, he's a big shareholder. Yeah. He is expressing that the demand is still incredible.
Yeah, you're feeling that demand from Jensen. You're feeling it from my peers across the infrastructure and cloud space. There were some very large deals. Ours was a $12 billion deal. There was another extremely large deal that was announced after that in the last few weeks. You're continuing to see broad-based demand for the product, for the infrastructure, for the compute to be able to drive artificial intelligence.
My sources indicate that there are many private equity firms that feel like, we got to bid off a little more than we can chew. Maybe we ought to sell them. Would those deals be accretive to you? Depends on the terms. But private equities, not everybody in private equity knew what the hell they were doing when they went into this business. You told me that would happen, and here it is. It's starting to develop, isn't it?
Yeah. So look, I think there are opportunities to position yourselves to take advantage of this wave. Right. And a lot of different folks took different positions in terms of how they wanted to address, the super cycle that's really being, that AI is driving. And our approach was to really start as close to the base layer as we could. The Core Scientific is another example of how we get down really to the bricks and mortar and kind of work our way back up through the physical compute, through the infrastructure stack, all the way up to the top level where you see Weights and Biases or other software extensions.
Now, you obviously have been watching the development of Oracle. Stocks doubled because they're getting in this business. Are they offering the same kind of thing to a hyperscaler as you do?
Oracle has its own set of products that they're offering, and they are a formidable competitor. They are one of the companies out there that I think that we compete with, in terms of being able to offer infrastructure to the AI labs that are offering infrastructure to the hyperscalers, but. From our position, we really believe that over time, what's going to differentiate us from anyone else is the software stack that drives the performance that we're able to achieve on our infrastructure.
See, I'm glad you brought that up because in the time we got to know each other, what I'm trying to explain to people is, look, Oracle's a great company, and we know, and Safra Catz is great, Larry Ellison's great. But when it comes to core competence, the people I know in this business want to work with you because you guys are what you said. You're kind of like you parachute in, when things are broken, which things do break. You are part of the stack. And in many ways, you are not just a dumb facility. You are a smart facility, which is why people want to partner with you.
Yeah, look, when we built our software stack, we kind of built it from scratch, right? Like we started with a blank sheet of paper and said, make every decision based on optimization of this infrastructure solution. We're not trying to incorporate any legacy technology. We're not trying to incorporate any history of success or failure. We're really just saying, based on all the options in front of us, what is the best solution? And when you face a problem that way, you really can build into your software, into your hardware, into the way that you deliver the compute, incredible performance enhancing step functions that just make it really easy to do the work that these companies have to do on our infrastructure.
And at your suggestion, I saw it myself with my team. I wanted to know for sure that this wasn't just like some empty place where there's just lots of different silos. It's very clear that it's filled with software that works very well with what Jensen brings to the party.
Yeah, no, it really is hand in glove. You got to be able to bring the hardware, you got to be able to bring the data center, and you got to be able to bring the software stack to deliver it. And
well, once again, congratulations. The stock, I understand how the stock had to be down because of a stock deal. I also know that the shorts are trying to jump all over it again. And my advice to them is good luck. That's Michael Intrater, co-founder and CEO of CoreWeave, a deal that we were really behind by the day, the moment it came public, and ever since then. Mad Money's back after the break.
Coming up, could the labor market be the key to a continued rally for stocks? Cramer's going off the charts to find out. Next.
Every so often, I do get a call about a company that I either don't know or simply haven't checked up on in a while. And whenever that happens, I always do the homework, circle back. Because this show is pointless if I'm not answering your questions. We are idea-driven with Mad Money. We're looking for ways to help you make money. We have to vet what you give us in this Vox Populi show. Which brings me to last Wednesday, when Chris in Pennsylvania asked about a company called Leonardo DRS. That's DRS for you home gamers. And I told him I'm going to take a look. This is actually an advanced defense technology company that's been around for a long time. It was founded in 1969 as Diagnostic Retrieval Systems. Back in the day, it was a pioneer in passive sonar technology for the Navy, which allows submarines to stay undetected during the Cold War. Man, these guys, they made out like bandits. And after initially listing on the New York Stock Exchange in 1981, the old DRS was bought by Finmeccanica. That's an Italian aerospace and defense company in 2008. Finmeccanica then changed its name to Leonardo in 2017. Fast forward to 2022, the DRS business re-entered the public when Leonardo merged with Rada Electronic. That's an Israeli defense contractor specializing in tactical radar. Under the deal, Rada shareholders got about a 20% interest in the combined entity, and Leonardo, the parent company, retained 80%. The combined business was named, yes, Leonardo DRS. So what does the new Leonardo DRS look like? The company gets 65% of its revenue from advanced sensing and computing. Think high-tech sensor systems, signal intelligence systems, and radar systems. That's the nuts and bolts of modern warfare. The other 35% comes from their integrated mission systems business, which makes advanced systems for power conversion, control, distribution, ship propulsion, force protection, and logistics. Specifically, they make a ton of hardware for the Navy. Their equipment is in some of the most important shipbuilding programs, including the Columbia-class ballistic missile submarine. As these heavy-duty submarines and other Navy vessels become increasingly electrified, Leonardo DRS thinks it's looking at a major opportunity. Altogether, the U.S. government is their largest customer, accounting for roughly 80% of total sales across the Navy, Army, Air Force, and the rest of the Defense Department. So that's what Leonardo DRS does, but how's it performing? Let's look at the most recent quarter. When the company reported back in May, they delivered a sizable revenue beat with 16% growth year over year. Both of their two big segments did better than expected, driven by strong demand for Leonardo DRS's electric power and propulsion systems, as well as their tactical radars and naval network computing programs. All of that translated into a 3-cent earnings beat off a 17-cent basis. Now, to be fair, Leonardo does have some exposure to rare earth materials, which have risen in price as China imposes stricter export restrictions. Remember, right now, the Chinese are the main source of this stuff, and our relationship with their government is tricky, to say the least. Specifically, management's highlighted their exposure to germanium. That's a critical component in the company's thermal imaging systems, where China controls 60 to 70% of the global supply. That said, management remains confident that the volatile tariff environment will have a minimal impact on their operations. They believe that their business is largely insulated from these pressures thanks to its primary geographic footprint in the United States, with their domestic supply chain predominantly comprised of American companies. While the U.S. government accounts for roughly 80% of Leonardo's business, the remaining 20% comes from close allies, Canada, Israel, South Korea. Their international business was a headwind for revenues this past quarter as the company lapped significant deliveries to Ukraine last year. But management believes that the rest of this business can outpace the growth of the domestic business through the rest of the year. Makes sense. Peace in the Middle East remains elusive. Another positive indicator. Leonardo reported a book-to-bill ratio above 1 for its 13th consecutive quarter, reflecting strong future demand. Put it all together, you can understand why the stock jumped almost 9% on the day it reported. So the business is sound. The numbers are good. So then we have to ask, what's the bull case for sticking with the stock? Keep in mind, Leonardo DRS is now up 46% for the year to date and up 83% over the past 12 months, meaning you're not exactly early here. That said, management's pretty optimistic about the future. For starters, they believe they can benefit from key defense spending priorities under the Trump administration, particularly in shipbuilding. This shouldn't be too much of a stretch, considering President Trump signed an executive order earlier this year to create the Maritime Action Plan aimed at revitalizing our maritime industry, otherwise known as the Make Shipbuilding Great Again order. Plus, the company's using an opportunity to benefit from President Trump's Golden Dome initiative, especially because they have the equipment to help counter drone attacks. It's such a good company. At the same time, it doesn't hurt that Leonardo DRS paid its first ever dividend just this year. While a quarterly payment of 9 cents and a 0.8% yield may not turn any heads, it's certainly a signal, right, that management is confident about its outlook, commitment to returning capital to shareholders. You don't start paying a dividend out of nowhere if you're all that concerned about making the numbers. Even better, Leonardo announced its first buyback ever this year, and even if it was only for $75 million, again, it does matter. Not a crazy amount, but always good to know that the company's in there buying its own shares right alongside you. So where do I come out on this one? If Leonardo DRS were still in the mid-30s, I'd be pounding the table. But now at 47 and change, like the other small mid-cap defense contractors, it's had a huge run this year, and the stock now sells for over 37 times estimates. Paying too much for those earnings. That's a little pricey for the company that's on track to grow earnings at roughly 17% clip. I'm willing to double that, say pay 34 times earnings, but it's a stretch. Here's the bottom line. I like Leonardo DRS, the company. I think it's exactly the kind of defense contractor that can work in this environment. But the problem is it has been working. It's very, very well where it is. All right, if you don't own it already, I wait for a meaningful pullback before you start a position. Yes, if you have to buy a little here, but then you got to wait for it to come down because it has had such a big run. Mad Money is back after the break. It is time. It's time for the White Round Question. That's right, for a quote. Save the name of stock. I told you about buy. Hustle, sell, just clear another course. Stop question. Time by Stanford's the graphics and play this one. And then the lightning round is over. Are you ready, Ski Daddy? Tell the light round. Chris, might start with Gary in Alabama. Gary.
Hey, Jim. I know you're a tomato connoisseur, and if you haven't tried the zebra variety, you should check those out. They're outstanding.
Well, that is a tip and a half. That's a tip and a half. Yeah. Thank you. 42%, 40% tariff on that. Go ahead.
There you go, the zebras. Yeah, this is a fairly recent IPO that I stumbled across a few months ago. I bought it. I've made a little money, but I can't find out a whole lot of info about this company. Tell me about Carmen Holdings.
Like, the missile defense. I mean, the missile story is good. That company came public in February. It's really worth a piece for us. We should be doing it. We did it at Leonardo DRS. These are the kinds of companies that are making a lot of people a lot of money, and I thank you for bringing it to our audience's attention. It came public in February. Let's go to Myra in Texas. Myra.
Much gratitude for the once-in-a-lifetime opportunity to come to the annual meeting in New York City.
Oh, boy, it's going to be fabulous. We're going to throw a lot at you. We got a lot of Jeff Marks and I got a lot planned. I did a lot of work this weekend on that, too. Thank you. I can't wait to meet you, and we'll get some pictures and have some fun. How can I help?
Yay! Thank you so much. What are your thoughts on Analyst Capital Management?
I have been against Analyst for many, many years because I think all it is just this mishmash of securities that I never know what they are because they don't really tell you. And it's got a big yield, but I want to own growth. Growth is the only safety in this market. Let's go to Jonathan in New Hampshire. Jonathan.
Hello, Cramer. How you doing?
I'm doing well, Jonathan. How about you?
Yes, I have a question. If Trump does invest millions or billions in technical schools, do you think schools such as Lincoln Technical Institute, LINC, should be a great long-term future investment?
Yes, I do. Actually, I do. And I've been thinking about that myself all weekend, that's where you want to be. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's got a bone to pick with some analyst downgrades of stocks that have had big runs. Don't miss his take on the names. Next.
It is time. It's time for the Lightning Round. That's right for a quote. Save the name of stock. I tell you my bad. Buy. Council sell. Just clear no course. Stock question. Time. My stampers and Cramer's play. Play this one. And then the lightning round is over. Are you ready, Steve? Daddy, tell the lightning round. Crazy. Let's start with Gary in Alabama. Gary.
Hey, Jim, I know you're a tomato connoisseur, and if you haven't tried the zebra variety, you should check those out. They're outstanding.
Well, that is a tip and a half. That's a tip and a half.
Yeah.
Thank you. 42%, 40% tariff on that. Go ahead.
There you go, the zebras. Yeah, this is a fairly recent IPO that I stumbled across 2 months ago. I bought it. I've made a little money, but I can't find out a whole lot of info about this company. Tell me about Carmen Holdings.
Like, the missile defense. I mean, the missile story is good. That company came public in February. It's really worth a piece for us. We should be doing it. We did it, Leonardo DRS. These are the kinds of companies that are making a lot of people a lot of money. And I thank you for bringing it to our audience's attention. It came public in February. Let's go to Myra in Texas. Myra.
Much gratitude for the once-in-a-lifetime opportunity to come to the annual meeting in New York City.
Oh, boy, it's going to be fabulous. We're going to throw a lot at you. We got a lot of Jeff Marks. I got a lot planned. I did a lot of work this weekend on that, too. Thank you. I can't wait to meet you, and we'll get some pictures and have some fun. How can I help?
Yay! Thank you so much. What are your thoughts on Analyst Capital Management?
I have been against Analyst for many, many years because I think all it is just this mishmash of securities that I never know what they are because they don't really tell you. And it's got a big yield, but I want to own growth. Growth is the only safety in this market. Let's go to Jonathan in New Hampshire. Jonathan.
Hello, Cramer. How you doing?
I'm doing well, Jonathan. How about you?
Yes, I have a question. If Trump does invest millions or billions in technical schools, do you think schools such as Lincoln Technical Institute, LINC, should be a great long-term future investment?
Yes, I do. Actually, I do. And I've been thinking about that myself all weekend, that's where you want to be. And that, ladies and gentlemen, conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Cramer's got a bone to pick with some analyst downgrades of stocks that have had big runs. Don't miss his take on the names. Next.
Let's talk downgrades. Sell. There are many kinds of downgrades in this business. Analysts might think that earnings are at risk, or maybe the company's already missed projections. That's an easy downgrade. There's the kind of downgrade where the company has lost its way and simply doesn't seem to be worth investing in. Totally justifiable. And then there's the valuation downgrade, where nothing's wrong with the company at all, but the stock's going too high for some analysts to justify a buy rating. I have no problem with the first two kinds of downgrades. We live in a market that punishes stocks for merely meeting estimates and annihilates them for missing estimates. Any analyst worth their salt is going to try to get you out of those situations. But valuation downgrades, never liked them. They get you out of a stock, but they never seem to get you back in at a lower level. Who's to say that an expensive stock can't go higher? It happens all the time. This morning, we saw a host of valuation downgrades, in part because this market's been so fantastic, at least until today. The most glaring, a firm called Seaport Research Partners downgraded Netflix to neutral after a fantastic run. Listen to this, quote, "We believe that plenty of long-term opportunity set is factored into the shares of this price, and the company needs time to execute against expectations in advertising, aggregating, launching experiences, and expanding shares again," end quote. Now, the risks mentioned, they're substantial. But Netflix has shown time and again that it can pull these things off. I think the company deserves the benefit of the doubt. If Netflix succeeds, and I bet they will, anyone who listens to this downgrade will miss another big move. How about CrowdStrike, the cybersecurity play that we own for CNBC Investing Club? This morning, Piper Sandler downgraded the stock. The analyst says he can't foresee anything near term that would, quote, meaningfully increase numbers or our terminal multiple already the highest across our coverage universe, end quote. Okay, so CrowdStrike's going up a lot and certainly expensive, but then get this, quote, yes, this is a valuation call again. There is a sense of deja vu as it was July of last year when we lowered our opinion on valuation, end quote. Again, I get that. I mean, if you recall last year on July 19th, CrowdStrike had a bug that shut down 8 million computers worldwide. We're about to annualize that out of Joe, and I think it'll be celebrated as one of the greatest comebacks in business history. Harvard Business School case study for certain. CEO George Kurtz met with as many customers as possible and kept most of the business, allowing the stock to roar. I think he'll get a lot of full-price contracts out of the companies he offered discounts to last summer, giving him a good chance to raise numbers. Number bumps coming. So I'm not going to take this valuation downgrade seriously, given the fact that the analyst was indeed dead wrong when it did the same thing last July. Full disclosure, we sold some CrowdStrike for the Charitable Trust in an effort to balance our portfolio, but we're not making a call to stock's valuation. We regularly trim our winners simply because we don't want to be greedy. Finally, Raymond James downgraded Wells Fargo, another Charitable Trust name, with the very dismissive, quote, downgrading to market perform. This is a strong buy to market perform. Wow. Favorable fundamentals reflect in valuation. Now, the analysts going from strong buy to hold at 2 markdowns. You think something was wrong, right? No. They just think the upside's baked into the share price. I think that's crazy. First, Wells Fargo is priced like almost any other bank stock, so it's not like there's a premium valuation. Second, these guys just got out of the penalty box when the Fed lifted its long-standing asset cap, allowing Wells to do more lending. Third, the bank stocks have become leaders here, and this is one of them. How the heck will this analyst get back on? I don't think he can. Again, I get it. The stock's had a nice run, but so many stocks have had runs so that's become a frivolous reason to downgrade. I don't blame the analyst community for getting more cautious after a major rally. They should. But some stocks deserve the benefit of the doubt. With Netflix, CrowdStrike, and Wells Fargo, you're buying into franchises with excellent bona fides and very smart CEOs. I'd much rather stick with these winners than sell them on valuation worries. I just don't think you'll be able to get back into such high-quality stocks at an easy-to-find lower level. I like to say that there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer, and I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.